What do Apple, Microsoft, Google, Facebook, Amazon, and Nvidia have in common? One, they're the largest companies in the world. Two, their first investors were all venture capital firms. Venture capital, or VC, invest in early-stage technology startups. VCs have some of the highest average returns at 19%, but the way they invest is through relationships and finding talented founders. Among 100 VC investments, only one or two companies may generate all the returns. This week, we talked with our friend David, who is recognized by Forbes 30 Under 30 for starting his own VC firm. We discuss what's important for VC investing, and even what he finds interesting in AI today. David, how did you get started in venture capital?
In college at Penn, I used to write a lot about startups, so I'd interview various early stage startup founders, initially for my personal blog, and then ended up writing for the Huffington Post and Inc. magazine as well, where I was interviewing the founders of Robinhood back when there were less than 10 people, the founders of Drift, some of these iconic companies. That helped me build my initial network. Then I ended up joining Dorm Room Fund, which was this student fund that First Round Capital, one of the premier early stage venture funds, had started, where they gave us money to invest in our classmates who were other student founders, with the idea that some of the best companies like the Facebooks and the Snapchats of the world come from college students and college campuses. And so that was my first real exposure into the world of venture.
How big is Comma now? How many investments have you guys made? And maybe tell us a bit about how you guys got started as well.
How we originally got started was in 2020. My co-founder, Adarsh, who I had met back at Penn, and I were talking about how we were seeing a bunch of our friends who were engineers, product managers, designers at some of these high growth companies. These companies were becoming more mature and starting to go public. A lot of the early employees who were our friends who had spent 4 or 5 years there were starting to leave to start their own companies. They'd go to us and ask us about, if I'm thinking about this idea, who are some investors that we should connect with, because they knew that we had this network of venture capitalists that we had met over the last few years and had developed relationships with. When we started to see that, we were like, if we want to be investors in the future, this actually might be the best time for us to start investing in people that we've known for a while and we've built relationships with and are asking us who are VCs that they should connect with. And we ended up raising our first fund, mostly from a mix of larger venture funds, family offices, individual friends, executives at some of these high growth companies, and started investing at the end of 2020. And that was mostly very early stage investing, roughly 100K investments, whether it was a part of a 500K or a $2 million round, and finding ways to support these founders. And so that was the original start. And 4 years later, we're now in our second fund.
And how many companies have you guys invested in at this point?
Out of our first fund, we ended up doing roughly 55 investments. And so these were pre-seed and seed stage companies. So typically very early, ranging from 2 people to sometimes 5 people, and maybe the first version of their product. That spanned across various industries, from software as a service to developer tooling to digital healthcare, to financial services technology. And and it's been cool to see some of them start to break out and raise subsequent Series A, Series B financing rounds, get to tens of millions in revenue, and start to build out their teams.
Out of all those investments, can you tell us about a company that you're really excited about?
Definitely. One of the early investments that we made was this company called Freshpaint. So when we first invested, it was just the 2 co-founders, and maybe they had a handful of customers, and they were going after this market of selling to companies that needed to better manage their marketing data, data that was coming into their websites, and then figuring out how to better analyze that. It took them maybe the first 3 years to get to early product market fit and scale, and starting to close 50 to 100 customers. 2022, they started to see a concentration around digital healthcare companies starting to use them because they were the only solution in the market that had this data privacy angle and allowed these digital health companies to remain HIPAA compliant while ingesting all of this data. And so I thought it was like an interesting opportunity, and the founders ended up actually doubling down in that opportunity, where at the start of last year, there was clarification to HIPAA that got passed that made it such that all these healthcare systems also needed to be more careful when it came to the marketing data they were collecting. And overnight, suddenly, Freshpaint was getting all this inbound from these massive healthcare systems and hospitals around the US. And typically, when you're selling to these massive organizations, it would take closer to 12 months to over a year to close them, but they were closing these like 7-figure contracts in 30-day sales cycles because of this regulatory tailwind. And the last year they increased revenue like tenfold and have continued to do really well. But yeah, it's definitely one of those things where for the first 3 or 4 years post investing, they had to like build out this infrastructure, figure out like what market to go after, build their reputation in the digital health space, and then eventually be there when the market timing was right, and suddenly they've closed all these massive healthcare systems, and they're just continuing to double down there and build more product and continue to scale.
If you were to think about the things that determine the success of an investment, what are the most important factors for you?
Given how early we're investing, I definitely think team ends up being the number one factor that we dig into, because so many things can change from when we first invest. We spend a lot of time getting to know the founders, what's their story, what motivates them, what's their chip on the shoulder, why will they spend the next 10 years trying to build the next like Apple or like Google and the next generational company. And then we dig into how do the founders implement each other's skill sets? Do they have the right technical background to execute on the product vision that they're trying to go after? And then is that complemented with somebody who can bring business sense and like go to market to close some of these customers? And then like, what are they exceptional at? And so the example of Freshpaint, for example, one of the co-founders had dropped out of college, was like an early engineer at various startups, had worked at Uber when he was 19, and was a contributor to like various open source software already at that very young age. And it was very clear that this person would be able to build not just anything he wanted, but like very like technical like advancements that would allow them to create like differentiated software over time. And so I think that's like an example of like something that we look for when we're evaluating some of these like technical founders. And so I'd say that's probably number one. And then shortly after that, like we definitely spend a lot of time thinking about the market and like where the world is headed. Obviously more recently, there's a ton of advancements within artificial intelligence. And so spending time leaning into that sector, figuring out what are industries that will have changes based on some of the more recent technologies. And I think there's the famous saying where you can't time the market, but you could be there when the market timing is right. And so I do think this is part why we like betting on founders who have a long-term view where they're willing to like stick around to like ride the right wave.
Typically when investors invest in venture capital funds such as yourself, they're worried that when the investment doesn't work out, it's automatically a zero. But obviously, in a lot of scenarios, founders will actually return capital to you. So can you just talk about that dynamic and how that offers downside protection for investors?
Founders that don't succeed and decide to call it a day will return, anywhere like between like 75% to sometimes like lower, depending on how long they've been working on the company, like say call it like 20-25%. In some ways, the venture asset class and like the venture portfolio construction makes it such that you really only need a handful of companies to become winners. And so say in a portfolio of 55 companies, if the top 5 companies in that portfolio ends up becoming unicorns or like even $500 million exit, like you'd already be returning the fund. So say we could do like some simple math, call it like we're investing $100K into like a company at like a $10 million valuation, and we own like 1% of that company. And when it becomes like $1 billion company, say after dilution, there's like 50% dilution. We end up owning like 0.5% of that $1 billion company that like returns like the entirety of like say like a $5 million fund. And so if you have like five of those, or if that one company becomes like a $5 billion company, then you're already at like a 3 to 5x fund, and the rest of the 50 companies that you invested in don't really matter whether they returned like half of the capital or like 20% of the capital you invested, because so much of venture capital is like being the outliers, and there's like a big power law of you want to be in the top companies.
What types of AI trends or companies excite you the most today?
Definitely a lot of things going on in the AI world. Everything from infrastructure, and we're seeing this in like the public markets when you look at like companies like Nvidia or like AMD, and all the software surrounding like building on top of these like chip companies. And so I think there's a lot of things around that, or even like Facebook and like Meta are releasing open source large language models like Llama 2. And then you see like Microsoft like more in the application layer utilizing their relationship with like OpenAI, and like and one on the infrastructure layer providing like the Azure cloud service, but then also like starting to integrate artificial intelligence into workflows like Microsoft Word. On the venture side, we also think a lot about both the infrastructure layer and then also the application layer. And so on the infrastructure side, something that we were very interested in spending time on was actually the open source large language models space, where you had these players like Meta releasing Llama 2, and then some other like open source models as well. And so we ended up investing in developer tooling that was making it easier for companies to leverage open source large language models. And open source will be a big component that will be driving that, as people will want more customizability, a lot more like data privacy and security, and want a little bit more control over their own data and like costs that are incurring as well as they're running some of these models. So I think that whole space and landscape is very interesting. I think we're very excited about applications of artificial intelligence in more traditional industries and vertical software. And so if you think about even, the early example around like digital health and healthcare, I think there's a lot of very manual workflows that these organizations have to like go through and deal with, whether it's from scribing patient data to then like collecting like certain types of information to filing claims. And so we're invested in a few companies leveraging the latest like AI technology to like automate some of these workflows, whether it's for like healthcare or like financial services, or even some of these more traditional industries, like say like commercial trade. Like you have these like our compliance, like ordering, windows cleaning type companies that have historically had very manual workflows, everything from note taking to the step-by-step process they have to go through, to the compliance workflows and like all these paperwork they have to fill out. I think all of those are opportunities for AI to make their lives like a lot more like efficient.
Thanks so much for taking the time to talk to us today, David.
Definitely. I appreciate you guys letting me share our story, and always happy to chat with folks about venture and what we're doing at Comma, but also the broader industry at large. I do think VC is one of those asset classes that traditionally has been a little like less like known or like accessible. So happy to educate folks.
Thanks for listening in. I'm Nick, and I've worked in finance for almost a decade. If you enjoyed this video, please give it a like and follow our channel for future videos. You can check out our WeChat group for more wealth and retirement tips. Talk to you next time. Bye.